Hello everyone. Welcome to the new series of monthly outlook of MoneyWorks4me podcast. We are recording this session on October 12th, 2021. I am Aditya and I'll be your host for today's episode. And to discuss more, I have our equity analyst Ketan with me. Hi Ketan.
Hello everyone.
To begin with, market are scaling new high. Sensex has reached 60,000 and Nifty has reached 18k. What's your first reaction, Ketan? And also, could you throw some lights on Nifty PE?
Equity markets today are definitely quite optimistic, no doubt about it. Demand is coming back. Most sectors are seeing V-shaped recovery and liquidity is quite high, which is taking the stocks higher. Now, India's benchmark index Nifty is up 55% in last 1 year and it is up 17% CAGR over last 3 years. Now, currently, the sectors like capital goods, infrastructure, real estate and related sectors are showing good strength. We expect economic recovery to help these companies in this sector report very healthy growth. Now, in terms of PE, the Nifty's PE has risen to almost 20 to 23 times forward EPS, which is higher than long-term average of 17. But the trailing PE of Nifty looks excessive at 27 times because a lot of companies reported low profits or losses due to lockdown for an entire quarter. So this cannot be considered as normal course of business. So this time it is better to use 1 year forward earnings for PE calculation, like I said, which currently stands around 20-23 times. This gives a better perspective on where we stand in terms of valuation. We also do Nifty MRP, which is our method of arriving at Nifty's fair value, which stands around 30% higher than so Nifty today stands around 30% higher than our fair value of Nifty. So it is definitely at a higher valuation. So maybe we have captured next 2 years of returns already at the Nifty level.
Okay. With such good gains in the past, does it look like markets may disappoint and expected to fall off?
Now equity will go up and down and never move in a straight line. Now this is a given thing. It's nothing like out of the blue. There is no magic formula to avoid such volatility. The correction of 10-20% is pretty normal, to be honest, and 40% crash is usually rare, but it happens once in a decade kind of event. But you are also rewarded with higher returns, isn't it? So it's fine to handle this kind of volatility and be prepared for going through such uncertain times. So when we look at equity returns, 4 out of 5 years are positive for equity. So we suggest that you better focus on finding right opportunities rather than worrying about correction. Now, like I said, markets are definitely optimistic today, but it is an aggregate picture, not a granular one. So the market consists of several stocks and not all stocks are equally expensive. Now, quite a few stocks are reasonably priced. Actually, even we couldn't believe ourselves when we were able to spot many reasonably priced stocks. So we went back to 2007 market peak, and what we found was even then there were so many stocks that were very reasonably priced, and lot of excess was only in the infra and real estate segments. As we know that market corrected 50% in 2008 and recovered by 2010, while headline index Nifty was flat for those 3 years. But 40% of the stocks in the market delivered positive returns from 2000 peak. Now 40% is not a small number by any means. And together these stocks delivered 17% CAGR over a 3-year period. And mind you, this is from the peak of 2007. So we are relieved that it is possible to find reasonably priced stocks at all times that can deliver good returns over 2 to 3 years. So we are optimistic that if we can build a portfolio of reasonably priced stocks, it will be very rewarding experience.
Very well. In that case, how is MoneyWorks4me building portfolio for future?
At MoneyWorks4me, we try to build future-ready portfolios. So what we do is we strive to find the new winners in the sectors that are showing promise of growth in future. So we usually avoid past winners or popular stocks as these stocks might be fully priced and very well known. And then there is a risk of disappointment if results are not up to mark. We already saw a large cap company like TCS tanked almost 6% on a result day despite reporting a very good results in our opinion. So in that case, we believe that it's better to get into those sectors where we can see emerging winners coming out. And now coming to our current portfolio positioning, we are invested in real estate related sectors like building materials, housing finance. Then we own companies like in infrastructure space, which is vast per se, but It includes industries like power, logistics, etc. And we continue to own banks and insurance companies as they are going to benefit from underpenetration in those segments. We also added stocks in this last 8 to 9 months as we saw early signs of economy pickup and government reforms directed toward these exact sectors. Now we have reduced the exposure to IT and pharma as we are seeing too much optimism priced into the stock price, and returns from here could be just moderate, so we are underinvested in them currently.
So Ketan, in this month's outlook, you have included an interesting study of how every market cycle has different winners. Can you elaborate more about this?
Yes, we have included a section called Celebrating Sensex at 60,000. Sensex started at 100 in 1979, and since then it has gone up 600-fold. Now it is just marvelous wealth creation of Indian markets. Now we did one exercise to find out that which stocks led to Sensex or Nifty's long-term performance. So instead of just last 5 years, we also studied several bull markets in the past and came up with an interesting observation. Every bull market saw a different set of stocks or sectors performing. In late 1990s, a lot of information technology, IT, which we call it, FMCG and media delivered very high returns. These got included into Sensex and even made it to top 10 stocks in Sensex and Nifty. But the performance shifted completely to infrastructure and old economy names in the subsequent decade, which is the 2000s. Now, for the best of 2000s, metals, oils and infrastructure were in limelight. Now, just like one would expect, popularity didn't last forever. And there was another shift to pharma and automobile from 2010 to 2015, and then to FMCG and banking in 2015 to 2020. So if you see that popularity changes every 5 or 10 years, if you hang on to the past winners, or worse, if you buy the past winners today, there is a risk of losing money or generating subpar returns in subsequent years. So if there is a single way to sidestep this kind of risk, I would say it is looking at the valuation with respect to the sectors or companies' long-term growth rate. Even today, there are several such sectors which are quite extended in terms of valuation versus the growth in the profits of those companies. So it is a wake-up call for investors to reshuffle the portfolio now, because it's a matter of time that institutions will bail out these old favorites and find other sectors more promising and attractive in pricing. This will lead to completely new winners in future. This is not me saying this is what history suggests.
So what do you suggest investor must do today?
If you are committed to do your own research, you have to check business performance on regular basis. Focus on 3 or 4 key financial parameters. 2/3 of the investment decision making is just detailed study of these 3-4 parameters. We have color coded these parameters in our 10-year X-ray of each stock. That can be your starting point. Top of the mind, I can say check for return on capital employed for last 10 years. Sales growth and profit growth of that company, and the debt metrics, whether it has low debt to equity or how is debt in respect to operating cash flows. Thereafter, check whether the stock price growth is higher than or lower than the profit growth or sales growth of that company over last 5 years or 9 years. Even if you do this, you will avoid largely all the pitfalls in equity investing. Post this, you will have to do a little more hard work to find the good opportunities, and this is not only for this year but for next several years. You'll have to keep finding these opportunities from time to time. If we see today, so many small cap companies where sales figures are way below 2019 levels are priced higher than they were in 2019. Now last year, every growth parameter looks very high optically because last year's sales and profits were quite low due to lockdown. So we see that stock price growth in quite a few small caps is much ahead of its profit growth today. And even here, this thing will help you avoiding and being cautious in the risk-taking behavior in small cap space. On the other hand, if you are not actively tracking the business or company filings, you must hire an advisor who will help you build a well-diversified portfolio. An advisor role in terms of how long you stick to your original investment plan and what percentage of your total capital you commit to equity can't be underestimated. So investing just a token amount or playing in stocks in a good bull market will not make you wealthy. But a 5 to 10 year investment plan on a significant percentage of your capital can do wonders to your financial position. So this is what my recommendation has been, that you focus on a longer term plan and commit a reasonable sum to equity, which will really help you achieve your goals.
Alright, thank you for your valuable inputs, Ketan. To all our listeners, you can go through the below link which I am sharing with you for this month's outlook. We have also shared some additional graphs and data related to today's topic. And if you have any specific questions, do let us know in the comments tab. Till then, happy investing.